As Gina shared, my name is Meg Klein, and I serve as the Vice President for Gift Planning and Trust Services here at the University of Illinois Foundation. We are delighted to partner today with the Tax School in bringing you what we intend to be a semi-annual webinar highlighting opportunities to blend financial objectives and philanthropic goals. And I'm going to let you in on a little secret. I really have the best job in the world. I get to meet the most fascinating people, and I really have the opportunity to take my financial planning, investment, and tax background and use it to work with their donors and their advisors on structuring gifts and making investments beyond the balance sheet to do some really good things in this world for future generations of young people and advancing research. So again, thank you. A little bit about the Office of Gift Planning and Trust Services. We are charged with providing informational resources to donors, their advisors, and our colleagues in advancement at each of the 3 universities within the University of Illinois system on ways to structure gifts to maximize the impact both for the university, the benefiting unit, and the donors' personal tax and financial circumstances. So my first slide. See, I'm learning the ropes here. I'm already muting myself, so apologies for that. My first slide today really kind of gives a quick overview of really what's a key component of effective charitable gift planning. And I know many of you on the call here today have probably worked with many of your clients who are charitably inclined and have worked with them to structure some wonderful charitable gifts. And so this may be rehashing old material that you're already familiar with, so forgive me. But I think the first thing that we want to do in working with any donor is to just really understand what are their charitable objectives. And any charity that your donors might be working with really needs to seek to understand that, because if we don't understand what they really want to achieve with their philanthropic dollars or this philanthropic commitment, we can't do our work effectively in ensuring we have a happy donor at the end of the day. I will tell you, I've never seen a situation where that's been good, where the donor hasn't been happy and we haven't understood clearly what the objective is. So that's very, very important in talking with your donors and with institutions that your donors may wish to contribute to. Secondly, and this is where I was on your side of the fence as an advisor for many years, but this is where, sitting where I sit today, we in the Office of Gift Planning and Trust Services don't know the whole picture like all of you as the advisor. And so we do ask some questions just to have a better understanding of what's the landscape of assets within their portfolio that might be useful to consider in making a significant and transformative gift or even their annual gift. But essentially, that's why we really encourage our donors that we work with to consult with their tax advisors, their financial planners, their attorneys, in particular with large and transformational gifts, because we don't have that whole picture. And so that's very, very important. And then finally, I think the third component that goes into effective charitable gift planning is really that particular donor individual's personal values and family considerations. Family dynamics are very real. And while we are not the advisor to get in the middle of those, I'm going to share some examples later on today that really highlight situations where we had donors who were charitably inclined and wanted to do something for charity in that particular vehicle actually helped solve or address some of the challenges within the family that family was addressing. So that always makes my heart happy when we can come out of a situation where we know that, gee, this donor was able to do something they didn't think possible and also maybe solve a family dynamic or other personal challenge that they were confronting. So again, we always encourage donors to seek out that advice. Our job is to really provide information because at the end of the day, we want to make sure we're aligning tax incentives with the assets a donor may be giving and the giving instrument. Not every giving instrument matches well with every specific asset type they may be giving. And I'm going to get into that example. So for all the attorneys out there, here's my disclaimer, and I will just tell you, and I think you and the advisor community will appreciate this. We always encourage our donors, again, to talk with their advisors before they make a major commitment. We will provide information. We will answer questions. I can tell you, myself and my team, we are happy to field questions from advisors, even if the gift is not coming to the University of Illinois Foundation. We believe all boats rise. We want to help support a culture of philanthropy in society. So if we or any of my team members, who I will share a slide of their contact information later, can be helpful to you individually, don't hesitate to reach out. There's no such thing as a silly question. We'd much rather at least share our perspective to give some guidance that might be helpful to you and your clients. It's part of our public service. So with that, I want to dive in and get started. And Gina, it wouldn't be tax school without a poll, so I'm turning it over to you. So poll number 1. And take a few moments, and I will not be offended by your honesty. Okay, the honesty being, if you're here because you're an attorney and you need an hour of CE before June 30th, that is A-okay with me. I understand. I have to get those myself. So how we doing, Gina?
Well, I don't show any answers yet. Let's see. Maybe it's taking a second.
All right. And again,
there we go.
Hopefully you're answering that. We'll see how they come in, because we want to make sure you get credit for today.
You see results?
No. And I'm looking here to see if I see results. And
well, here, Meg, let me just break in and I'll let you know. We have 32% have said A. D, all of the above, has 41%. And so and then the rest go on from there.
Great. Thank you so much, Gina. Thank you. All right. Well, let's move right along here. And let's talk a little bit about our objectives today. You got the objectives in the materials that were sent to you when you registered. My hope today is we have 3 primary components of today's presentation. We are going to focus our agenda today around charitable gift annuities, deferred gift annuities, and charitable remainder trusts. Those are 3 instruments that we see often utilized that are sometimes not very well understood very broadly, because it is kind of a unique niche out there under the tax law and tax code. And so we're going to focus in on some of the finer points of those instruments and things that each of you as advisors probably want to be aware of in working with clients who might have interest in these vehicles. We're going to talk about some of the tax implications associated with these instruments. What are some of the benefits of these instruments? What problems might it solve for your individuals? And then the third case, we're going to talk about some specific cases that really kind of look beyond just the fundamental tax benefits and really get into planning strategies that might help solve different challenges. And I'm sitting here today with Gina in Mumford Hall, and the air conditioner is working very, very hard today. So if you hear a little rumbling in the background, please forgive us. There's not much we can do about it, but I know we would certainly melt into a puddle if we didn't have that air conditioner. So I hope you're staying cool wherever you are at today. So I'm going to start off by one of my favorite quotes, and by Aristotle. I've worked with hundreds of donors over the years that have saved their whole life, and they reach this pinnacle of their lifetime, and they have more assets and money sometimes than they know what they want to do with. And they are sometimes stuck with, what do I do with this? They want to make sure they're providing for family, and they want to pass wealth on in a responsible manner. And they also oftentimes have a charitable interest or philanthropic interest, and they want to know, how can that be also part of their legacy? So this is not easy, and I will tell you what I tell every donor when I sit down with them is that we often are going to come up with a plan for today, but it may be a plan that includes a gift from their estate plan, and it may be that portion of their planning is going to change over time. As you know, it's not necessarily set in stone, and so we're going to adapt and we're going to shape to their needs over time as their circumstances change. So I like to think about charitable giving is putting all the pieces together in a big just jigsaw puzzle. One of my vices is I love jigsaw puzzles. I could probably sit for hours and waste hours and hours of time doing jigsaw puzzles. And I think one of the fun elements of charitable gift planning is taking all the different pieces and knowing there's this one little piece called charity that we are trying to fit into a puzzle piece and make them all fit together. Now, for your clients, maybe the charitable planning piece is not a piece in the puzzle. It's not for everyone, and I understand that, but I think there are a growing number of individuals who really do want to see that to be a component, whether it be for themselves personally or as part of their overall family planning, strategy. They want to encourage their children to, know about philanthropy and giving and charitable giving as well. And so it's a lot of fun when you can get multi-generations involved in establishing charitable gifts. So with that, I'm going to dive right in, and we're going to start with our next poll. Gina?
Yep.
All right, most people give to charity for the tax benefits. True or false? And I can see it now, it looks like. And so good. I'm not seeing anybody respond yet, but all right, it looks like almost 70% of you say, 65% say false and 35% say true. Well, you're both kind of right, I will say. This was maybe a little bit of a trick question. Maybe people aren't honest, but when you poll them and ask them all the reasons they give, tax benefits generally fall about like number 8 on the list of 1 to 10 in terms of reasons why people make charitable gifts. Now, are they lying? Who knows? But I do believe that tax benefits are not the primary reason that people make charitable gifts. And that breaks my heart because, I love to save some people money on, taxes if we can. But what I think you'll find is most people are really driven by the mission and the passion for the work that a charitable organization is doing. And that is the number one driver for why people give. I will say, though, that where the tax benefit comes in my experience, is donors will often make larger gifts than they thought possible if they are structured appropriately and maximize all the tax benefits available to them. And so, important consideration. All right, we answered that. All right, let's dive right in. Charitable gift annuities. I wish I could see your hands and see who's heard of a charitable gift annuity, but we're going to talk a little bit about the basics. And forgive me, a lot of my slides show the University of Illinois Foundation as the charity, but please know in many cases, these are planning strategies that can be utilized with any charity. So again, I'm going to use some examples that will not all be University of Illinois Foundation, but my examples in these slides will have the University of Illinois Foundation front and center here. I will also say whether or not a charity can do something is going to depend on the type of giving instrument. So a charitable gift annuity is a pretty common investment giving instrument that many charities offer, particularly large national charities or charities in higher education. However, keep in mind there are smaller charitable entities that do not have the size required by law to actually issue a charitable gift annuity. And so you may have a donor come to you and say, I really want to give a charitable gift annuity with XYZ charity that's very small, local charity. That charity may not offer a charitable gift annuity. So I just want to be clear that these are not instruments that necessarily every charity offers. So essentially, what is a gift annuity? The donor, essentially, it's a contract between the donor and the charity where the donor makes a gift of cash or generally a security, a liquid asset of some sort. And in return, that charity agrees to pay that donor or the income beneficiaries that donor names a fixed amount, dollar amount, for the remainder of that income beneficiary's lifetime or lifetimes, okay? And so you can see how that works. And at the end of that income beneficiary's lifetime, it could be the donor, it could be someone else. I could have another illustration here that had another income beneficiary out here to the side. But when that income beneficiary or beneficiaries, when they pass away, the remainder value of that annuity contract comes to us at the University of Illinois Foundation, or the charity in question, and is used to support the purposes that the donor specified. So getting a little bit more into the details, I always like to see the visual, but also the words and the text. It's a fixed lifetime payment based on the age of the income beneficiary or beneficiaries. Gift annuities are offered for lifetimes, so either one life or two joint lives. Income for yourself or others, I already mentioned. One thing about gift annuities I'm going to talk about, this may be for an outright, a gift where payments begin immediately for that income beneficiary, or it could be that they're delayed to some future point in time. For example, I've had donors that we've worked with on our team who they're maxing out all of their retirement savings and they still want to save more, and they're not willing to part with access to that asset. And so what they've done is they've opened up charitable gift annuities with us that don't pay for another 10 or 15 years down the road, actually, and they get a tax deduction for that today, for that gift where the income is going to be received in the future. One thing about gift annuities is you get an immediate tax deduction, income tax deduction, both federal and state. One thing to keep in mind, that's assuming you itemized, number one. Number two, that calculation, we have software we use to run that calculation. We can run it by hand, but if you have a donor interested in this, we're always happy to run a calculation. That calculation is really basically the present value of the remainder interest that we as the charity anticipate we are going to receive. So a lot of things go into that, but the age of the income beneficiaries and the current interest rate environment are the two primary drivers that are impacting that charitable deduction that the donor will be eligible for. When the income beneficiary is receiving cash payments, or their payment, it's coming in different forms. It's part of it is a tax-free return of principal to the donor, and it's not taxable. Part of it may be taxed as ordinary income. Part of it may be taxed at the capital gains tax rate. And so I will tell you that in the, over the early years of the life, it's kind of a combination of return of principal, capital gains, ordinary income. And then once you get out beyond the life expectancy of the income beneficiaries, then it's all taxed as ordinary income. But essentially, that's the very quick and basic on the taxability. We do provide donors with a tax projection as to what that income tax, the taxability of those income payments is going to look like down the road. And we always encourage our donors to be thinking about how do these income payments impact the overall tax picture. While I would love to say that we, open up, hundreds of these a year, I will say we often sometimes talk donors out of this. It doesn't mean it's not a good tool for a donor to consider. It just may mean that I think sometimes people really want that tax deduction. And when you sit down and show them this illustration and the tax savings and what they're getting in income, they're like, well, gee, the tax benefit means more to me. I'll just make an outright gift. And so again, we're always happy to run illustrations and talk through scenarios, but you may find that depending on what the donor's objective is, these may or may not be the best instrument for them to consider. And the last thing to keep in mind is that charitable gift annuities are a general obligation of the charity. So I think it's always important that donors consider this, that, if it's a charity that's not on stable ground for some unforeseen circumstance, and they go bankrupt or under or close their doors, there goes their payments. I mean, this is a general obligation of that charity. So for the University of Illinois Foundation, all charitable gift annuities. We have over $100 million in charitable gift annuities and charitable trusts on our books. Those are general obligations of the foundation that we are paying out to donors for their lifetime. So moving on here, and in light of time, I'm sharing with you, and I'm not going to dwell on this, some of the specifics of the charitable giving gift annuity rates. They actually just were increased, actually. And what you will find is that these vary again by ages, but I put those out there just so you kind of see where those rates fall. I will say that given the risk nature of charitable gift annuities, they kind of look like a CD. So I think sometimes a donor I had one donor who had a lot of her investments tied up in CDs. She was very, very conservative investor. And while that had its risks, she did take and open up a gift annuity, because that gift annuity, actually, she was charitably inclined. She knew that was money she wanted to ultimately go to the university or to the charity she wanted to benefit. And she was able to get a much higher income yield off of that CD than off that gift annuity versus a CD. So let's look at a quick example before we move on here. Here's Milton. He's 80 years old and retired. He's adequate savings and reserve funds. He primarily lives on his pension, Social Security, and a modest income he receives from his portfolio of CDs. He's a very conservative investor. Primary motive is to ensure enough income while minimizing the variability of his income. He wants to benefit his church, but he knows he's not in a position to give away those assets now that he might need to support his lifestyle. So what might work for Milton? Well, in this case, for Milton, he decides to do a gift annuity with $50,000 in cash. And I will say every charity has a different minimum. You can open up a charitable gift annuity with the U of I Foundation for about $10,000 as a minimum. Most of my experience, at least with higher education institutions within the Big Ten, are all at about that $10,000 level. Milton's payout rate, based on his life expectancy in this scenario at the time this projection was run, was 6.5%. So essentially, he'd be getting $3,250 a year. It'd be paid out in 4 quarterly installments, at least with the U of I Foundation, it would be. You can see the taxability of those payments to Milton, and you can see his charitable deduction there. And again, this was cash, and so you can see the deduction limit is the same as a cash gift would be. It's 60% of AGI with a 5-year carry forward. So the deduction limitations is also something we always pay attention to, at least with donors, is to make sure they can use their charitable deductions. And sometimes donors don't care, but oftentimes 9 times out of 10 they do. And so when they're on that borderline or bubble, we always point this out to say, you might want to make sure you go back and talk to your accountant to make sure you really can use all of the deduction that's on the table here. Because if you can't, maybe we need to spread these out over time so you can take advantage of those deductions. All right, I'm seeing a few Q&As. Nope, I'm not seeing Q&A. So I think we're good. And no questions in the chat, it doesn't look like at this time.
One.
Okay.
Q&A published. You don't have to now.
Okay, question from Stephen. Let me look. Does one need to fund a charitable gift annuity with cash, or can assets be donated? Excellent question, Stephen. Assets can be donated. Every charity is a little different in terms of what they would accept. We have accepted real estate into charitable gift annuities, but that is very rare. Generally, most charities will prefer it be a liquid asset. So appreciated securities, if it's a stock portfolio, cash, something that can be sold and liquidated fairly quickly, are generally what most charities will accept into their gift annuity pool. So let's look at another example here. Alma Jones is 55, and in her peak earning years, she has she has maximized all tax-deferred savings opportunities available to her through her employer. I always think that's an important thing to stress. I will be honest, personally, if a donor came to me and wanted to do this before they were taking advantage of all of their retirement savings, I would question, is that the best strategy? But she remains concerned about saving enough for retirement, and she plans to retire in 10 years at 65. She wants to support scholarships at the local college, but concerned again about giving up access to her assets. To give, say, $10,000 outright, she's concerned she might need access to income from that asset in the future. So how might a deferred charitable gift annuity come into play? Taking a look for Alma, she decides to give $25,000 in cash. At her lifetime, if she delays payments for 10 years till age 65, her payout is 5.5%. You can see her annual payment amount, how those payments are treated from a tax perspective, and how it will be treated after her life expectancy. And you can see the charitable deduction that she's eligible for. I did see another question. I think we're getting ready to go to a poll question here. We need to go to here soon, if I'm not mistaken. But hold on 1 minute, Gina. Does one need to fund a charitable gift annuity? Oh, wait. No, what happens if Milton dies in year one? Christopher, that's an excellent question. In all of these cases with charitable gift annuities, when the income beneficiary dies, whatever remains goes to the charity, even if payments didn't start. If Alma here in our example funded this at 55 and she died at 60 before she started receiving payments, she would have never collected any of the benefits from it. It would not have changed her charitable deduction. It's just like an insurance contract in some ways. You win some, you lose some, which I hate to say that, but I think that's one thing that donors have to be mindful of. If it gives you any peace of mind, we've had donors live to about 107 before on gift annuities. And so again, our personal experience is we have about 60% remainder interest in most charitable gift annuities that we receive. But on average, it really is kind of an insurance contract of sorts, and that donors, that's why it's so important that donors know that these are assets they were going to give to charity anyway. It's not like you can give this now, change your mind once you've set it up from there. I think we're ready for a poll question because of time. And so here is our question. In 2020, over $471 billion was given to charitable organizations in the U.S. Is that it?
I pushed out the wrong one.
Nope.
Sorry.
Oh, sorry. No, maybe I have the wrong one. Oh, never mind. I'm sorry. Charitable gift annuities can be issued by charities, banks, and any other financial institution. True or false? I gave him a sneak preview on the questions coming down the line.
Looks like it's at 50-50.
50-50. All right. Thank you, Gina. Let's close that one. The answer there is really false. Okay. Gift annuities, charitable gift annuities, can only be issued by charitable organizations. Okay. There are other types of trusts we're going to talk about that banking institutions can issue, but charitable gift annuities may only be issued by charities, and not every charity issues those, and not every charity issues them in every state. I know at the University of Illinois Foundation, there are a handful of states that we do not issue charitable gift annuities in because of some of the, I would say, regulation requirements are pretty onerous, and we don't have enough of a donor base in those states to justify the expense and time to monitor those. So it's always important to ask that question too, is, if I'm working with a charity and it's not a national charity, are they issuing in the state where the income beneficiary resides? So, and there was the poll. So let's wrap up on the basics of gift annuities here. Again, it's regulated state by state by departments of insurance. That's the other thing about gift annuities. They are regulated actually by departments of insurance state by state, not nationally. So we actually register with, I think there's about 35 states that we issue charitable gift annuities in, and we register with each of those states, and each of those states have unique features that they require us to adhere to, with California and Florida being two of the stickier ones, but ones, at least for us, we have a lot of alumni in those states, so we do issue there. I mentioned not every charity issues in every state. There are sometimes restrictions on how that is those gift annuity contracts are invested. That has no bearing on your client's payment, because we are actually obligated to pay that fixed amount for their lifetime, regardless of what the performance is of that annuity contract over its lifetime. I mentioned the general obligation issue. Some charities reinsure their gift annuity pool. We do not. We feel like we're large enough. We self-insure, but there are some charities who do that, and that does add cost to the administration of those programs. Keep in mind, and this is important, there is no option to invade the principal if they need the funds for anything. So if Milton, in our first example, gave us $50,000 for a charitable gift annuity and then decided he needed $10,000 to go out and buy a new car because his car went kerplunk, we are not going to be able to give Milton, $10,000 from his charitable gift annuity to go buy that car. So keep in mind, it is irrevocable, and we are only promising the income stream. I think that's a very important conversation we have with donors before we accept a gift annuity, particularly larger gift annuities, are that we want to make sure that they have enough liquid assets. They're not giving us something they're going to need to invade the principal for. I had one gentleman call up, and he was just tired of managing his affairs, and he wanted to give us all of his assets in a gift annuity. And we said, sir, that's very generous of you, but no, we're not going to do that, because obviously you may need some of those funds for your living expenses that might come up. That would not be a good idea. So again, we try to be good partners and point these things out. And the last thing I think all of you as accountants and tax planners probably want to know is it does remove those assets from the donor estate. Once those are given to the charity, they don't fall into the estate for estate tax, purposes. All right, we have another question here. And I mentioned charitable, how the charitable deduction is calculated. That basically is a software program we have, and there are certain variables. And Carolyn, if you send me a note afterwards, I can go into the detail of what goes into that calculation. But the deduction is basically the present value of the remainder interest going to the charitable entity. Is there a certain age when it doesn't make sense to fund an annuity anymore? Arlen, that's a good question. I've had donors do it in their 90s because they've decided, so I think it's an individual decision on charitable gift annuities. In some cases, I had someone fund a charitable gift annuity because they still wanted some of that income, but they wanted immediate tax deduction. So they didn't want to leave a bequest to us because there's no immediate income tax deduction to leave a bequest. They could use the income tax deduction, and it got the asset, out of their estate, even though they didn't have a taxable estate. And I think they had a over 8% income payout on their charitable gift annuity, and they funded it in their 90s. And so again, there's going to be a lot of factors that go into it. Unfortunately, I think that's where most donors have to do the cost benefit analysis. And I would again stand by the premise that any donor making a gift of a charitable gift annuity must feel confident that they want those assets to go to the charity. While it kind of acts like an investment vehicle, first and foremost, it's a charitable giving, I emphasize giving, instrument to think about. Who calculates the charitable deduction amount? That's a good question. We will actually, at the University of Illinois Foundation, we will prepare a tax package for all of our donors that will tell them what the deduction is. We will substantiate the deduction and give a tax receipt and tax package, which shows what they are entitled to based on the calculations and IRS guidelines for those deductions. There's a great question about IRAs and 401k, 403b plans. I will circle back to you on that, Dan, a little later in this presentation. And I don't think there's any we're missing. And, oh, yes, Alan Bauer, you had a question about does the donor get to use the charitable deduction once the deferred gift annuity is funded? Yes. So we have several donors, charitably inclined, who have maxed out their retirement savings. They would like more tax deductions, so they have funded deferred gift annuities for themselves or for children or for siblings or other family members along the way. So I'm just going through this. Spoke a minute about to open, what's the maximum? For a charitable gift annuity, that depends on the charity. Most charities, I will say for us, we will take $1 million charitable gift annuity with due diligence. Most charities, it's prudent to look at the size of the gift and what it does to your pool of gift and of the gift annuity pool in terms of your risk exposure, so to speak. So I think there are some charities who would probably be very reluctant to go over $1 million with a gift annuity, just knowing what the obligation might be, or they might say that you should, reinsure. So again, every charity is different. Quarterly payments, your illustrations show quarterly payments. Those payments could be made monthly. You can, each charity is a little different. Our preference is to pay them quarterly, but we do have other payment schedules that we will entertain with a charitable gift annuity. And Francis, your question, in the month of death, the payments stop with the last payment prior to date of death. Okay, so again, some really excellent questions. I'm really pleased to see those. All right, well, let's switch gears. We talked about gift annuities. Now let's talk about charitable remainder trusts. And I'm sitting here thinking, gee, we could have just had one session today on gift annuities and forget about charitable remainder trusts. But I think charitable remainder trusts are very similar to gift annuities with some very distinguishing differences. And I'm not going to read the illustration here for you, but essentially, there's a lot more flexibility with these. A unit trust has variable payments. So instead of it being, you give us $10,000, it's a 5% payout that you're going to get the rest of your life, a fixed dollar amount. With an annuity trust, a unit trust, it varies every year. So it might be, you gave us $100,000 into a charitable remainder unit trust at 5%. At the first year, you're going to get $5,000. The next year, if the markets go up, and now it's the value of that trust is now $110,000, you will get 5% of $110,000. Or if the market goes down, you might get 5% of something lower than what it was originally funded with. We've had some really strong and robust and good markets here. So a lot of our charitable remainder unit trust donors have seen incremental gains. In fact, we've had charitable remainder trusts actually pay out more than what they were funded with, just based on, the timing of those payments. But essentially, charitable remainder trusts, unit trusts, are very flexible and have some benefits that the gift annuity does not offer. There's a question from Jessica here. Do you ever have to claw back payments when you learn of the death after a payment has been made post-death? Yes, that has happened. We always like it when people tell us when somebody passes away, but yes, unfortunately, we have had circumstances arise where some payments were made after a donor's passing, and we've had to go and collect those payments back per the terms of that annuity contract. All right, some basics here on charitable remainder trusts. Unit trusts, variable payments, changes annually. That's good and bad. I do think charitable remainder unit trusts over long periods of time are going to provide a better inflation hedge than what a charitable gift annuity is, because that charitable gift annuity, the dollar amount you receive is never going to change. Whereas a unit trust, most of them are in a 70-30 equity fixed income portfolio. And so it will vary with market conditions. Unlike a gift annuity, which may have a payout rate less than 5%, charitable remainder unit trusts require a 5% minimum payout rate in order to qualify per IRS standards. And we have a lot more flexibility on the payout rate. We generally follow ACGA or American Council on Gift Annuity recommendations on rates for life income gifts when setting those rates, because we want to be prudent investors of these assets. But essentially, there has to be at least a 10% remainder interest going to the charity in order for it to qualify as a charitable remainder unit trust. Minimum age varies by the institution who is the trustee of the charitable remainder unit trust. For the foundation, we have a stated minimum of age 55. We have made some exceptions, and we do have trusts that, the unique thing about trusts is they do not have to be for a lifetime. They can be for a term of years. So I've had donors actually set these up where we have, done them for 4 years and they paid, a grandchild payments during college to fund their college education for those 4 years or 8 years or some term of years. So there's a lot more flexibility. Trusts are not a general obligation of the charity. Okay, so if for some reason there would be very poor investment performance and the trust would exhaust, the payments also stop to the income beneficiary. And there is more flexibility in terms of different types of trust. You can have little flip provisions and other things I'm going to talk about where you could fund. We have a lot of CRUTs that are funded with real estate, highly appreciated real estate, farmland, other assets, where a donor gives us those properties. We put them in the trust. As soon as we sell them, we convert that trust to a straight charitable remainder unit trust paying a fixed income. I see we've got a question from Anna. What is better when markets are down and interests are up? I don't know if I completely understand, when is this better? I think the higher the interest rate environment we're in, the higher the rate you will be quoted based on age, because they do look at the interest rate environment and issuing those. So we've been in such a low rate environment. A lot of our gift annuity rates historically have been low, and those don't change. So somebody who a year ago opened up a charitable gift annuity has a rate that is probably 20 to 50 basis points lower than the rate we would quote them starting in July because of the interest rate environment. We don't go back and adjust the rate for those. They're locked in at the time that charitable gift annuity is established or that charitable remainder unit trust is established. But don't always think a higher rate is better. I will tell you, it's a trade-off. The higher the rate of income payout, the lower your charitable deduction. So what's important to your donor? I've also seen charitable remainder trusts that have had, let's say, a 5% payout rate instead of a 6% payout rate. And because of the reinvestment and the revaluation every year, over time, the 5% payout trust is actually paying more out to the donor than the 6% because of the reinvestment of those proceeds back into that bottom line of principal, for which is driving those investments year in and year out. So I hope that helps give a overview of the basics. And I'm going to jump into a case here for charitable remainder unit trusts. So we have Red Grange. We're going to have a few Illinois examples here. 65 and is supporting capital improvements for Illinois athletics. He wants to support. He's got Galloping Ghost technology. He has very low basis stock. So this gets to the question that was asked earlier of, can you fund these with other assets besides cash? The answer is most definitely yes. Red in this case has a very concentrated portfolio of stock. He's got high, low basis. This would be very expensive for him to liquidate. He really needs some income off of this stock. And maybe it's a growth stock that's not really generating much in the way of dividends. So what does he do? Well, he decides that he is going to give us $500,000 of Galloping Ghost stock at a cost basis of $100,000. So for 5% of income payout rate for the rest of Red's lifetime, revalued each year, he is going to receive income payments. What's attractive about this scenario is we hope over time that the investment markets continue to go up over long periods of time. So in year one, he'll get $25,000 of income from his CRT, and it will vary each year thereafter based on the January 1st revaluation. Payments are going to be taxed at a combination of both ordinary income, capital gains tax rates, and tax-free. But he also gets a very nice charitable deduction in this case that he can deduct up to 30% of his adjusted gross income, and he can carry that forward for 5 years. The $400,000 in capital gain, yes, he does have to pay some ordinary or capital income gain tax on that in the form of how his quarterly payments are treated. But he's spreading that out over a longer period of time, and generally is more advantageous for most donors to consider this. This is a very popular strategy, particularly for donors who have really concentrated positions of securities. And we've done this with closely held business stock, publicly traded stock. It varies. So the one thing I will talk about too here is that the one other unique thing about charitable remainder unit trusts that I mentioned to all of you as advisors is these can be issued by financial institutions. So sometimes we have had donors who have really great working relationships with their advisors, and the advisor wants to keep those funds with their advisor. So, pick your bank, Busey, Northern Trust, JP Morgan, Charitable, Schwab, Fidelity, Vanguard, the list goes on. I'm not excluding anyone, but most entities that have trust powers will actually allow for donors to set up a charitable remainder trust, and those are trusts held outside of the University of Illinois Foundation or outside of the charity, and might benefit multiple charitable organizations. And so that is an option, I think, sometimes that donors forget about, and sometimes the advisors forget about, is that they can actually continue to manage those assets for their clients while allowing them to set up and get the charitable tax deduction. So 2 questions in the chat. Who invests the funds donated? It depends on who the trustee is. In the case of the University of Illinois Foundation, we actually invest them in basically low load mutual funds, passively managed mutual funds. And we have several models. I would say, 85% of our donors choose a 70-30 model and conferring with their advisors on what they want to select, but we have some that are a little more conservative and some that are a little more aggressive. If somebody decides to have a bank and financial institution be their trustee, they certainly have a lot more control over the investment selection, and their advisor could actually pick those investments. There are some restrictions on what you can hold in a trust. So again, it's always important that if an advisor is doing this, that they are mindful of the underlying requirements of CRTs and the tax treatment. So the more trading in a CRT, the more short-term gains, the higher it is as ordinary income tax. And then I see one other question popping up here. Payments to RED will vary but never fall below $25,000 unless the charity goes under, correct? That is not true, Michelle. That is for a gift annuity. So for a charitable gift annuity, if this was a charitable gift annuity where the payment was $25,000 a year, that would be correct. But for a charitable remainder unit trust that RED funded, that is a variable payment. So it would be $25,000 the first year, but it would be different the next year based on paying out 5% of whatever the market value was of that trust as valued on January 1st of the following year, if that makes sense. And I'm happy to clarify that. But that's one of the, the main differences between gift annuity versus CRUT or charitable remainder unit trust is the fixed versus variable. And I'm getting the look from Gina here that we need to do another poll. So let's take a moment here, and if you can take a look at that poll. In 2020, over $471 billion was given to charitable organizations. Which sector received the largest percentage of those gifts? Give a few more minutes here. And I think we can close it here. It looks like education and religion are up there. And you know what? You're right. Education and religion do lead the list. There is a slide later in your packet that shows the results. 28% to religious causes, 15% to education. So it's interesting, during the pandemic, we saw a bit of a shift in this. And we saw a lot of your local social service agencies, human service agencies actually inched up a little bit. I know that was 2020, but if we look at 2021 numbers, which I've not seen yet, I think the spread and the percentages are getting closer, I think, particularly as, obviously a lot of hunger, food banks, and other crises, healthcare inched up, obviously, in the middle of the pandemic. So pretty interesting information to follow. All right. Let's keep going along. Back to charitable remainder trust. And I see we've got quite a few questions that I'll circle back to if we have time, but I want to make sure we get through some of these examples here. And I know we will go probably a little closer to 3:15, just because I know we started a little after 2:00. But one thing about charitable remainder unit trusts to think about is they can be a nice tool for, funding a pension for children. I had one donor recently who established a charitable remainder trust that's going to pay their daughter, who does not have a pension, income for life starting at a certain age in the future. I had one donor who had a sister who was financially dependent upon her, and she was worried that if she outlived her sister, who would provide for her, and she didn't necessarily want to leave her a large lump sum of cash, so she set up a charitable gift annuity in that case for her. But I've seen it done with trusts as well. I've also seen some donors do it as part of a charitable planning strategy instead of a direct payment or a handout. I remember a gentleman many years ago, early in my career, who his sister didn't have a lot of means, certainly not the means he did, and he really wanted to see her have more income to do things she wanted to do, but she would never, ever accept the money directly from him, her brother. It was too proud to do that. He set up a charitable trust, and she was the income beneficiary, and he was able to basically tell her, well, Jane, I wanted to do this for Illinois, and I had to name an income beneficiary, so I selected you. It's kind of I thought it was pretty sweet that he wanted to provide for his sister, but do it in a way that he felt like she was maintaining some pride of not taking a handout from her brother to support her. So all kinds of ways these tools can be utilized. A few other additional considerations with charitable remainder trusts. The IRS, again, provides all the regulations. I want to field one question here from Jessica. Can you share obligations of the trustee to the residual beneficiary and the income beneficiary? It is a shared responsibility. Okay, I will just say, and I'm happy to follow up on that question, but essentially, you have to balance those needs of both the remainder beneficiary and the income beneficiary in terms of how you pick the investment models, payouts, etc. Does the charitable remainder trust need to file a tax return? Yes, they do. And if we are the trustee at the University of Illinois Foundation, we will file it for you, actually, for a whopping $75 fee, which is, no offense to the tax preparation people out there, but we will do that, recouping the cost of our tax prep software. But yes, we do. If you do have these trusteed outside of the University of Illinois Foundation, say with another charity, with your banking institution, you will need to ask your CPA who will be filing that. The trustee is responsible for filing that tax return, essentially, and how they charge for that. A lot of banks will outsource those. I've also seen donors be their own trustees or co-trustees, which is feasible. A few other things about charitable remainder trusts, and this is really versus gift annuities. I mentioned more flexibility in funding assets. With the CRT, it can be for a term of years. It doesn't have to be for a lifetime. Again, financial institutions can serve as the trustee. There is a 5% minimum payout. To answer a question just popping up in the chart, can a special needs trust be an income beneficiary? Yes, we have several charitable remainder trusts that we are trustee of that actually pay income to a special needs trust. And I've got some examples coming up that show that. Again, better inflation hedge. If somebody was doing a CGA at age 65 and doing a sizable one, I'd be very concerned that you were locking in a fixed income payment for a lifetime. There's no option to invade the principal. Just like a gift annuity, if the donor needs that money back or says, I now need, I need more than the $25,000 my trust is giving, we can look at what the, how the money is invested to see if we can maybe, invest it more aggressively, potentially to get a higher return, to have a higher base level to multiply the final year. But in general, there's no invading of the principal on those assets. The other thing to keep in mind, the only other option is to dissolve the trust. And we have done that. We have had income beneficiaries and the donor, if they're one and the same, run into situations where they really they need those assets back. And when that happens, we dissolve the trust. It's a taxable event to them as the income beneficiary, and we take our income our future income comes to us, or the remainder, and they get what's left. So there are some options. I'm not going to, that would be CRT's part 2 that we can talk about. There's a question here about 1099-R and K1. If somebody opens up a gift annuity with us, we issue a 1099. If they open up a charitable remainder trust, we do file the K1. So varies based on the type of instrument. But excellent question, Francis. All right, we did this poll, so we are going to skip right along. And we're going to get into some of these examples. And I know we're down to our last 10 minutes, but I think in the last few minutes, I can give you some examples, and you will have these examples at your discretion to look at. And again, happy to provide more detailed information on any of these in any follow-up conversations. Or maybe they'll invite me back to talk about case studies part 2 at some point. All right, so I've already talked about some of these things we can do. Convert low-yielding assets into higher-yielding assets, reduce tax burden of highly appreciated assets, eliminate management headaches and issues. That's my favorite one. I love to share some of the stories of things that have been done that have really solved some big problems for people. So here's a prime example, farmland. Okay, I'm a farm girl from Central Illinois, and I will tell you that this is a true story whose names, Henry and Hazel's names, have been disguised to protect them. But we had a couple step forward that had a farm of about 350 acres. They, bought this farm a long time ago. It had very low basis in it. They bought it as an investment to diversify their portfolio. They didn't have some of the sentimental attachments of, oh my goodness, this is my father's and grandfather's and great-grandfather's farm with it. But they did have a lot of respect for their tenant, and they knew their tenant was getting on in age, probably wouldn't be farming, for more than another 3 or 4 years. But they didn't want to sell the farm and not have the tenant have access to farming that land. So the other concern that was weighing on Henry, Henry kind of liked to follow the markets and go to the coffee shop and do all those things that, I know my dad loves to do. And he was really, though, concerned about, I'm not really ready to sell it, but I'm worried if something happens to me. Hazel does not want to have the headaches of managing this farm. And Henry was doing the farm management. There was no farm manager involved. We talked about, well, have you considered having a farm manager take over? And they didn't want to do that. They were charitably inclined. They wanted to do something for the university, but they also knew they needed this income. So what did they do? They actually gave us the farm to the University of Illinois Foundation. Henry continued to manage it as the farm manager. We were the trustee, and we did it as a charitable remainder trust with a flip provision. Essentially, what did that mean? We held the farm. In this case, we ended up holding it about 3 years, and we just passed the income straight through to Henry and Hazel, the net income. We filed the K1 for them for tax purposes, all of those things. Nothing changed. Tenant stayed the same. When the tenant said, I'm ready to retire, tenant retired, we sold the farm. When we sold the farm, after the tenant was done, we and we had the right to sell it before that, but we just kind of had a mutual understanding here. We sold the farm, the CRUT flipped to a 5% straight payout rate, and we started paying Hazel and Henry 5% of whatever that annual valuation was for their lifetime. Okay, so in this case, they eliminated the concern for Hazel. She had peace of mind that if something happened to Henry, the University of Illinois Foundation would step in and take over the farm management. Or sell the farm. It was continuous income, and they got an immediate income tax deduction. And this was a couple that actually did have a taxable gross estate, at least in Illinois, and it solved some problems on that front as well. So again, that's just one illustration of how charitable remainder trust can solve problems. Let's just go right along here. Secure Act. The Secure Act, as many of you know, eliminated stretch IRAs where you could name a non-spouse as beneficiary and stretch those distributions from the IRA out over the joint life expectancy. It condensed that down to that 10-year period. We've seen some increased interest and actually established some charitable remainder trusts that are actually going to be testamentary CRTs, where we We have funded these trusts with $100, and that trust is the beneficiary of, John Doe has no spouse but has children. And so he has done, made this trust the beneficiary of his IRA. And so everything will pay out when he passes away to the IRA, and then, or no, from the IRA to the charitable remainder trust. And then that charitable remainder trust has an income beneficiary, i.e. the child, and it will pay to the child for their lifetime. So there are some gift tax considerations in that illustration, potentially, if there is a taxable estate, those kind of things. But a CRT can also be useful in that operation, and I've illustrated this in your handouts. All right. And I'm going to skip this one, but it's just a gentle reminder that not all assets are created equal. You got donor 1 and donor 2. In general, assets that are subject to required minimum distributions or IRD assets generally are great assets to leave to charity because we don't pay taxes on those. So again, this shows just the example of the donor who gives $1 million in stock to the charity and $1 million IRA to the kids, accounting for the tax. Donor number 2 gives $1 million in stock to the kids and the $1 million IRA to the charity. The donor number 2 comes out ahead net because we don't pay income tax. So just a friendly reminder when doing charitable planning that not all assets are created equally. And just a quick reminder on beneficiary designations, and this is an important point, and this may be the only U of I Foundation commercial you hear from me today, but it's that make sure, please make sure as advisors that you reach out to the charity, even if you don't want to share the donor's name, and ask what the legal name is and the tax ID number of the entity you are naming as beneficiary in their trust or will, or as the beneficiary designation on a retirement plan or POD or transfer on death provision. I'm going to say, if you have donors who want to benefit or support the University of Illinois, please leave all gifts to the University of Illinois Foundation. I assure you, life will be simpler and donors will be generally happier because we are the official gift receiving arm of the University of Illinois. So again, important point, and I couldn't miss this opportunity with so many advisors on the line to point this out because I suspect some of you have University of Illinois donors in your portfolio, but please leave those to the foundation. I will also say that we don't ask these questions to be rude or nosy or intrusive, but we do want to make sure we completely understand what donors' intentions are with those gifts that are left to us. Okay, so if they leave a gift to the University of Illinois Foundation, we would like to know, okay, what college, what university. Don't just say College of Medicine, because we have 2 colleges of medicine. We don't just tell us, oh, liberal arts and sciences. Well, you want liberal arts and sciences at Springfield, at Chicago, at Urbana. So again, we ask some of these questions for clarity to make sure we can honor donor intention, because we do see, we do really take that seriously. And I saw early on in the comments, we have, I think, one of our foundation board members on the call, and I think he would appreciate knowing, yes, we do ask a lot of questions because we want to make sure we are honoring that donor's intention when they are no longer here for us to ask. And then the last thing I will say about beneficiary designations, if you do have donors who are interested in establishing a bequest for the University of Illinois Foundation, for the Urbana campus, we currently have a challenge grant that we have received that expires June 30th. And essentially, donors who make new charitable gifts, if they are over the age of 65, will receive a match of up to $10,000 for an unrestricted gift to the unit of their choice or to one of our chancellor's priority funds. So again, there's a link, and maybe in the chat, I think Gina just shared that if you've got donors who are, or clients who are University of Illinois donors to the Urbana-Champaign campus. We have been promoting this, but it is a great opportunity for the donor who's left in a state provision. I don't want anybody to feel like they missed out on $10,000 they could have allocated to the charitable priority that they selected. So All right, I think we need to go to the last poll here before we wrap up here. So it is open. I'm going to look at the questions as we're here. And again, this is the last one about what you'd be interested in hearing more about. Again, I hope you will find this to be useful information that you'll use with your clients. And if we do this again, what you tell us is really, really helpful to us in, planning future sessions. And it looks like retirement assets and estate planning are all, well, they're all up there. I think we could be busy for a while, I think, here, Gina, if you'll have me back, if my reviews aren't so horrible that you decide, nope, we're not having her back. All right, let's go back to some of the questions while we're wrapping that up. Is there a minimum for the remainder in a CRUT? Yes, Joseph, that's an excellent question. Per IRS guidelines, when you do the calculations and the analysis, which again, there are software programs for this. We have those software programs. I can tell you, we are happy to run the projection for you. There has to be a 10% remainder of the CRUT. So if somebody funds $100,000 CRUT, we have to at least be projected to receive at least $10,000. Now, I will say every charity has different rules and stipulations on that, but in general, from an IRS perspective, 10% remainder value is the minimum for a charitable remainder trust. Paula, if IRA is paid to a CRT after death, isn't there still income tax to the trust beneficiary? We have actually seen that be viewed as paying to a charity and avoiding, it's a gift to the charity, and actually it has avoided income tax on those funds going to the CRT. So I'm happy to have an offline conversation with you, Paula, but we have done this several times and it's not ever been taxable to the estate. At least there's been a subsequent charitable offsetting deduction for that. All right. I'm going to give two more examples, and I know we're right up to time. CRTs to manage spending. I'm not going to read this example, but I will say we did have a woman who set up a charitable remainder trust because she had a son who had been a drug addict most of his life, and while he had gotten sober and clean, she didn't want to leave him a large sum of money that he could just blow through or go back to bad habits. So she set up a charitable remainder trust. He's the income beneficiary. He's going to receive enough income that he can pay his rent and live a modest lifestyle, but hopefully it's not so much that it's going to get him into trouble. And he actually, or she actually was charitably inclined. So that has worked out to be a beautiful arrangement, actually. Spending, again, manages spending. We did the poll. And I will leave you with this most important page. This is the team in gift planning and trust services. We are here to help. We do have a website that I think in the chat, maybe you've already put that there. We have a lot of information on our website that's available, including e-booklets on all of these various charitable strategies. We are more than happy to send them to you, whether your client is interested in giving to us or giving to other charities. Again, all boats rise. We're in this to be good ambassadors for all charitable giving. I will also say that you will be receiving a survey, and in that survey, there will be a question that asks you if you would like to subscribe to our Philanthropy Advisor newsletter. I promise by signing up, we will not harass you. We will not bombard your inbox, but what I will tell you is in that newsletter has different charitable topics that we get, and it's very good. It's very well done, but I will also say it has a wonderful resource library that I've had many advisors and attorneys, CPAs tell me that they have really enjoyed going to that as a go-to resource. So again, if you subscribe to the newsletter, you'll get access to this database of information on all the tax regulations on charitable gifts that I think you'll find very, very useful.